Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
I have a theme. I have a theme today that investors will be judged not by the size of their portfolios, but rather by the content, risk, and return of their portfolios, so that every investor can have the same opportunity for wealth in the American dream. Folks, it's not MAGA, it's MIGA. Make investing great again. All right, I love me some MIGAs. I want a whole bunch of little making investing great again investors running around, and that's either plural for my favorite investor type or my favorite Mexican breakfast. Love me some MIGAs. Folks, welcome to Your Money Radio, because it's your money, not their money. See, the broker-dealers, the custodians, and even the government thinks it's your money, their money on loan to you, but in actuality, it's our money, your money, and we're going to keep it and we're going to invest it, and we are going to follow this theme throughout the show. So the theme is Don's favorite line, follow the money. Or the other side of the coin, the same thing is price equals truth. So whenever you hear me say follow the money, price equals truth, or follow the charts, FTC, those are all the same thing. Okay, now, you'll understand as soon as we get into the mailbag why I'm setting this up. And the couple articles are America's New Supercycle, out with the old and in with the new. Folks, are you ready? Are you ready? That reminds me of the Warriors. Remember that movie in the early 80s? Are you ready? The Warriors, what a great movie. Anyway, and then very quickly, and then the other article is the long road to the de-dollarization. Everybody's talking about de-dollarization and what's going to happen, and should they buy gold? We're going to talk about that a little bit more. But there's a lot of big issues with de-dollarization. We'll talk about that. Then there are a few other articles. I'm not going to go into those. Ed Yardeni thinks the bond vigilantes are coming out to play because of the exploding UK and American debt. And there's a couple other regulators. What's his name? I love this. JP Morgan, Diamond says it's time to fight back against the regulators, and SEC Chair Gary Gensler says he's going to regulate until the Fed calls the whistle. So there's a big fight going on between the regulators and the broker-dealers. Oh, I don't know about what, best interest or fiduciary, right? Remember, we've been laughing about this. We've been a fiduciary for 20 years. Ever since I founded this company, I've been a fiduciary, even before that. So do you have a fiduciary for your advisor? If not, why not? No, really, why not? Now you just got to look over your shoulder. But being a fiduciary isn't good enough. You got to have good strategy. Just having a fiduciary just is the way they get paid. If you still have that pie charts or us portfolio with the buy and hope and some arbitrary date of rebalancing, that's not what we do here. Anyway, all right, let's get right into it. And I am going to go into these articles, and they're very good. Oops, sorry, drop that. All right. So the two articles that I wanted to talk about, all right, is America's New Supercycle and the China faces a long de-dollarization, because these are related. And the thing that's really important is you got to pay attention to the currencies. Currencies, just like a stock, it's all about supply and demand. So I'm going to go through this as quickly as I can. American New Supercycle. We're undergoing a historic shift. We're leaving one long period of expansion, what economists refer to as a supercycle, and entering a very different one. Last 15 years, weak demand, low rates from a hangover of the Great Recession. Experts say we're coming out of it. These are the same experts that forgot to tell you to get out of the way of inflation, by the way. And here's what I like. The world has changed. We are now entering an era of higher growth, creeping inflation, and geopolitical instability. And it's going to reroute the flow of money around the world. Folks, that's already happening. All right. The good news is unencumbered problems put a ceiling on growth in the previous era, But over the old period, where the risk of deflation, the lack of demand, caused wages and prices to spiral downward, that was the trap they were scared about, so they took rates down to zero. With super cheap debt and where people overexpanded and overhired. Folks, when you take rates down to zero, you skew economic reality. Good deals get well done as well as bad deals. There is no discrepancy. Okay, it's like low tide. When low tide goes out, now you know who's not wearing a bathing suit. Okay, when it's high tide, everybody's fine. Okay, anyway, it says the pro-risk environment had some earth-shifting consequences. We got the internet on the phone. China blew a big real estate bubble, but the massive government stimulus spurred by the pandemic, it reached escape velocity. So what he's saying is it helped all this stimulus. See, this is where I disagree. But it says now economists, these same economists that missed, right, are saying we're going into three sweeping forces. First, higher rates will reward savers, making it more expensive to take risk. That's correct. So the difference between good stocks and bad stocks will be much bigger than it will in the past when rates are at zero. Now you're supporting, that's what they mean when they say zombie companies. Okay, you're supporting zombie companies. Second, geopolitical and economic volatility will generate inflationary effects, reintroducing soaring prices. Ooh, not sure I agree with that, maybe. Third, industrial planning will be greatly influenced by national security concerns, altering supply chain. So basically saying a centralized government. Okay, now, this new era, okay, is a completely different new era. It says entrepreneurs that fail to embrace this profound impact of new economic era will have time on their. In other words, they're going to get in trouble. We are in a time with less. We were in a time that was less demanding and more forgiving, but that time is ending. One of the clearest signs a new supercycle has arrived is when financial rules go topsy-turvy. Now they're arguing. Previous supercycle ushered in, and he said the structural shift will cause shockwaves around the world, yields will spike, and treasury bonds tanked. He's telling you what's happened, right? And that's when you had WeWork, and you had all these companies with no viable plans to make a profit, and they were selling for billions of dollars. That's over. With the new supercycle, money managers will again be forced to adopt to these new economic realities. Now, here's one thing that he said that was interesting. He said that once they started raising interest rates from 22 in 22, he said the markets didn't tank like they always did before. BS, it did. We had a bear market in 2022. In 2023 and 24, we recovered from that, but I don't know what he's thinking here. Okay, now, lastly, he said that unless you're a baby boomer, you've never experienced a world with these high rates. Don and I remember these very well. The Fed's higher rates are putting a strain on sensitive sector stocks like housing, et cetera. It says what we can expect from the new super cycle, we're going to have upsides and downsides. Rising rates means loans more expensive, forcing businesses to make more thoughtful decisions. Okay. It will also boost savings accounts and interest. In any event, what he's saying is shifting away from growing at all cost mindset of the previous super cycle, incentivized by government spending, is now over. It's going to have profound consequences, and you're going to have to pay attention. Are you ready? We are. We've been doing that the whole time. So it says, so my comments, I wrote some things out. And why wasn't any of this told to us in advance? Why are they telling us after the fact about these boom and bust cycles? Okay, here's his ending comment. For over a decade, we've been accustomed to an economy working on a certain way. This new super cycle will have to adjust our expectations. And I love this line. He said, the economic equivalent of natural selection. Those who adapt will be the most likely to survive. Folks, listen, here are my comments, right? Number one, you should have a stable currency. It's the Fed. He's trying to say that the Fed came and tried to save the market after the financial crisis. It's the loose money and the easy money and the printing of money that causes these boom and bust cycles. You need a stable currency like physical gold. They can't print it. They can't manipulate it. That's why gold is stable. That's the difference between an Austrian and Keynesian economy. So you must always follow the money, the order flow, the demand and supply for stocks, bonds, whatever it is. It's always supply and demand, whether it's the US dollar and inflation. Okay, look, folks, if you have tons of dollars, lots of printed dollars, and you print more, but you don't produce anymore, that's what inflation is. So if you increase the supply of dollars, you increase the supply and demand goes down, what does that mean? That means price drops. That means the dollar's worth less. That's the same thing as devaluation. So whenever they say inflation, or they say, they use the word devaluation because they don't want to use the word inflation. That scares you. Inflation and devaluation are the same damn thing. They're exactly the same. They're interchangeable. Okay. Now, I said you must follow the money. Okay. Revere does that in real time. We see these changes as they occur, not after the fact. Why wasn't he writing about inflation and warning about it before? Remember, in 2021, I was out there saying as soon as they open up the economy, you're going to get the multiplier effect in and bonds are going to get slaughtered. Inflation is coming. Now, it doesn't matter because whether I was right or wrong with my forecast, we're going to see it on the charts. And if I'm wrong, we're going to sell it. I'm not going to follow my beliefs or my forecast. We're going to follow the charts. Okay? The whole point is he is telling you to be prepared and be ready for the shift. And we've been doing that on a daily basis, not monthly, not quarterly, not annually. By the way, on a side note, when they approved the 850 billion, because he's talking about this race to zero, he talked about that 3 or 4 times, folks. In 2008, 2 days after they announced the $850 billion bailout, my former partner, Dan Kofal, asked me what I thought it was going to be, and I told him it would be a race to zero with both interest rates and currencies. I was the first one in the country to say that. Did my economic forecast, it was the first in the world to say that, help me make money? Maybe a little bit, not much. It's the technicals that help me make money, okay? So following the charts are for when you're wrong more than when you're right. They help you pick the right stocks, but they keep you out of big kimchi if it doesn't or when it doesn't work out, because not all of our stocks will work out. We know that in advance. When we buy something, we already know in advance where our sell spot is, okay? If you don't know where your sell is when you buy a stock, you're a retail rookie investor playing with professionals, okay? So what is your plan? How are you going to follow the money or follow the charts? All right, with that, I'm going to turn it over to Don and see how we're actually following the charts and what we are actually doing in real time. So with that, Don, take it away, brother.
Thanks, Dan. I was fortunate enough to be a guest on the IBD Investing with IBD podcast Wednesday after the close, and did a deep dive review on the market and on our process. If you haven't had a chance to see that, that's free and it's available out on YouTube. Just search YouTube for Investing with IBD podcast and you'll see it. Got a lot of positive feedback from that, so people enjoyed what we had to present there. So I was asked, it's out on YouTube Live, and we were bullish on the market at the time. I brought up the trend gauge and showed how we had the 4 green arrows there, meaning leaders were working, our short-term, medium-term, and long-term trend. All the major indexes were above those levels with the exception of the Dow, which we weight lightly when we're making that decision. But I was asked what would make me less bullish than what I am, and I brought up the chart that we discuss and show, and it was this 16-day consolidation that we were in on Wednesday. And after the close on Wednesday, Meta and Microsoft reported and were gapped down at the open on Thursday, and you can see the gap down here on the chart. But not only did we gap down, we proceeded to sell and close near the lows of the day, and that took us below this line in the sand, so to speak. And that changed. It also took us below the 21-day moving average, which is our short-term indicator. That's the green line there. And the slope of that line has rolled over. So that happened on Thursday. Friday now, we had Amazon and Apple reported earnings. Apple's down 2% right now. Amazon is up 7%. Maybe there was just some window dressing, some selling going on into the close for month end, or people picking the trick instead of the treat on Halloween. But we gapped up this morning. It was also weak payroll data in the non-farm payroll report, but we gapped up and we're holding it. We're holding that gap so far. So where do we go from here? Back to the 60-minute chart. This took us back above this line in the sand level from this breakout. Okay, so 1 day below. Very frequently you get a shakeout, a 1 day below shakeout. And if that's all that yesterday was, then we take a look at what do we need to do to get back in the good graces of a bull market. And back to the daily chart, we need to get back below this green line, the 21-day moving average. I mentioned it's rolled over right now, and price is coming up into it. Additionally, the purple line there, which is our ultra short-term moving average, or the 8-day, is getting ready to cross below the 21. We really put the pedal down as far as how much money we have allocated to the market when we're trending above the 21-day, even more so above the 8-day. So we're clearly below the 8-day now, and it's rolled over. We've been for 2 days. Second day below the 21-day. We're really kind of in a hands-off mode now as far as adding exposure until we get back above this 21-day moving average. And we certainly, to the downside, will get more defensive if we break the line in the sand, the new line in the sand, which is the 50-day moving average, which is where we paused yesterday on the pullback. That's right around the 5,700 level. So as of right now, we're kind of in a holding pattern as far as our index exposure goes, as long as we hold the 50-day moving average, or the 5,700 level. As far as adding exposure back, we want to get back above this 21-day moving average on the S&P 500. Now, this isn't an absolute. If we see something that's acting extremely well, something we already own that is breaking out with massive volume, or something that gaps up on volume, we may take a small shot at it. But for the most part, we're more in going sideways mode than we are in looking to grow, and then we'll look to protect more should we break the lows of yesterday. But I say it all the time in the videos that Growtection is a dual mandate. Grow assets during uptrends, protect them during downtrends. And we do that across 3 time frames. And each of these, 1, 2, 3, this is the 4th time this year that we've broken below the 21-day moving average. Sometimes actually the 5th. One was just a 1 day below. But what happens is if we get below there, we just, as I said, ease off a little bit, tap the brakes, and let the market tell us what the next move is going to be. So we got stopped on a couple things yesterday. No big deal. We sold out of those. We've got stops in place for everything. And I really went into detail on that IBD podcast about how we set our stops and calculate the downside if all of our stops would get taken out. But for now, so more of a holding pattern. We downgraded the short term from bullish to neutral because of the break below the 21-day on all of the indexes. And we also had the Dow breaking below the 50-day and small caps breaking below the 50-day yesterday. Now they're recovering it today, which is exactly what you want to see. There's the Dow Jones Industrial Average back above the 42,000 level and back above the 50-day moving average. But notice how since it broke the 21-day moving average, this green line, that green line has been acting as resistance on any rally that the Dow has attempted over the last 7 sessions. That's what we do not want to see on the S&P 500 or the NASDAQ 100. Let's go to the small cap index, the Russell 2000. You can see also regaining the 50-day moving average and that 2200 level. But where do we pause today? And the day's early. It's just 10 after noon on Friday. again, ran into that declining 21-day moving average, and we're pausing. So this is definitely something we're keeping an eye on. Can we reclaim that level? We're right at that level on the NASDAQ 100, and that's where we're pausing again. So until we clear back above that level and get 2 closes above it, and we also downgraded our leading stocks indicator from bullish to neutral because we got stopped out of a couple names. 19 of our names in the 21 over 21 list were down yesterday, and 7 of them broke below the 21-day moving average. Actually, 8 of them now broke below the 21-day moving average. So that's the feedback for how our leaders doing. We were very bullish since the 9/11 follow-through day, and it's time to just rest a little bit and see what the market has to offer. We've had a bunch of earnings reports this week, 5 major ones. And of course, we had the employment report today. We survived that, but we've got the election on Tuesday, and also the FOMC decision on Thursday of next week. So we'll have to see not only what the results are, but how the market reacts to those results. So now it's just time to not be aggressive. We have our best results when the NASDAQ 100 and S&P 500 are above their uptrending 21-day moving average, and we're just not there right now. Doesn't mean it's a disaster. We're still above the 50-day moving average. We also have levels of exposure for the 100-day moving average or 20-week, the 150-day moving average or the 30-week, and the 200-day moving average. This is where all bear markets occur. This is where we really get the heck out of the way. It's normally about a 10% pullback from the top to when you get to the 200-day moving average. And then we see what happens when we break there. But this is when you're at risk for a bear market. They all historically, without exception, occur below the 200-day moving average. So that's our line in the sand for exposure to the market.
Let me just jump in and clarify a couple things. So, folks, as the market starts breaking certain levels, he's going to take layers off. So once we hit the 200, he's already gotten some defense. He's raised some cash.
Mostly.
Mostly. He hasn't, it's not like he's waiting till the 200 and then he's raising all the cash. When we hit the 200, that's the last bit of exposure that we're going to let loose of. So we're already very
right, and that's index exposure. We will have been stopped out of most of our stocks, individual positions.
Yes. Whenever he's talking about those, he's always talking about the broad index level, the exposure, not the individual stocks. Always have their own rules, and they're taken out individually on a case by case, individual stock basis. That's the first thing. The other thing I wanted to clarify was when he was talking about he's got those 12 or what did you say, 18 leading stocks that fell out of the 21 over 21 list. That is not
8 of the 21.
8 of the 20. That is not all the stocks we own. We don't own these stocks. We own a few of them. We own some of the best of those that he likes the most. Those are his tracking to give him feedback of whether to reduce exposure, increase exposure, to buy or sell, or how aggressive the portfolio to be. We don't own all those. So I just want to, because we get new listeners all the time, I just want to clarify that he's actually using these as indicators, not necessarily a position in the portfolio. Go ahead.
Right. Yesterday, two of the 10 individual names that we own, the stocks that we own, we got stopped out on because they broke the 21 and triggered our sell signal. So that's pretty much a summary of where we are, more in a holding pattern as of right now to see what the next move is going to be for the market. We're entering the traditionally most bullish 2 months of the year. But obviously, with the big events next week with the election and the FOMC, we'll have to see what the reaction to those are. And ultimately, it's going to be the market itself that tells us whether we need to lighten up or whether we need to add more exposure. We do everything we can to take the emotion out of it. And that's where the saying, the market climbs a wall of worry, came from. If you just pay attention to the headlines, because fear sells. If you pay attention to the headlines, you would never have a nickel in the market, because the news media is going to tend to overplay the negative. But that's not what we do here. And that's where we are right now on our look at the market. So from there, let's go first to Connor. He's going to have an interesting breakdown of some Fintech stocks. So take it away, Connor.
Thanks, Don. Yeah, so I got 4 stocks today to talk about, and it kind of factors into Ted's stage analysis presentation today, but definitely seen a sector theme shape up a little bit. And Don, if you go to TOST, that's the first stock. So this is a combination between TOST as a payment processor. I'm sure if you go out to eat or been to restaurants, you've seen their product. And this kind of fits the same fintech industry that I'm talking about. So this first one, Don, if you go to the weekly chart, and one thing that specifically in the sector that I've been seeing is a lot of these are setting up classic stage 1 base breakouts. And what we've talked about stage 1 bases before, but basically the key thing is you want to have some conviction that it's ready to move out. Is first thing is to get above that 30-week moving average, which TOST did. Started to build higher lows, and now it's breaking out of this base, and you can see the earnings line is very attractive, and then the relative strength line is also confirming. And really, when you start to see names come out of a big stage 1 base, they can have more upside versus buying a stock that's already been on a run for weeks to months on end, and you have clear, well-defined support below. So this one's acting well, and if you go to the daily, back to the daily, Don, you can see this is breaking out and putting in new highs today, given the last 2 days of the market have been relatively weak. And yesterday was not the best day for the market, but when you're trafficking in growth stocks, down days for the indexes are good days to find the stocks that are strong. The ones that are bucking the trend, and you can see today, this one's breaking out after yesterday being just down a little bit. So this one's definitely on the top of a radar looking to get in, and chart looks good, and it's definitely starting to make the turn. So that's kind of like a name in the payment processor group. And then some of the other fintech stocks, AFRM's another one. Been following this one for some time as well. And basically this move got started on that earnings gap. And this stock is no stranger to volatility. You can see it undercut that earnings gap low and then fired right back up, and then came right back down again and ripped right back up. And now it's sitting right at the 50-day. Now this one has earnings in 8 days. So obviously that's that's your decision, but likely not enough time to get cushion. So I'm mostly watching this on earnings. And if you go to the weekly, this has another pretty textbook stage 1 base that it's forming here. And it's, you can almost argue it's a inverse head and shoulders pattern bottoming formation as well. And you can see that big downtrend line that is broken. So this one looks good. And these are more so the type of earnings gaps that I would prefer to buy, is coming out of a long period of neglect. Obviously, this was a high flyer in 2021 and basically was in a downtrend for 2 years. And now it started to come back up. And that's a clear change in character. And this is just another reason why at Revere, we don't hold on because it's a good story. If you held on to this stock, it's massive underperformance and holding a loser. But now price action showing a change in character, and some other things driving this group is rate cuts is obviously the clear catalyst. And these should still benefit quite a bit moving forward, as we're likely going to get another 25 basis point cut next week. And then the next one is Upstart, same sector as well. And again, this was another super strong name in 2020 to 2021. And this one's pulling back to the 21-day along with, it had a very strong run off that earnings gap. And now it's kind of starting to fill a little bit. 50 is a clear level. If you look to the left of the chart, that was a big breakout spot, but this one's pulling back to the 21-day. See if it can hold. If not, you have that 50-day below, and then again, earnings in 8 days. So that's something to keep an eye out on as well. And then last one is SOFI. Now this is one that has reported earnings already, and it initially on the report, it gapped down lower, but you can see a huge bounce off the 21-day. So to me, that signals some institutions came in to support it on the gap down. And this one has another very similar look. just a big stage one base, earnings starting to turn around, and I like how it got bought up off that earnings. Go to the weekly, Don, as well. Looks very similar to these other ones. And another character change is, you're starting to see some volume come into these as well. So that's definitely, the group is speaking to me a little bit with how all these are setting up. And there's a couple other things to consider. Likely, sometimes I refer to some of these stocks as kind of, like a beta play. Primarily, they're going to work when IWM is working as well. They kind of all fit into that basket, but the price action and the volume signatures on all these names look really good. And then one thing I did want to mention as well is I noticed this week, stocks like Twilio and Roblox gapping up on earnings. And something we've actually started to see is some of the Mag 7 big tech stocks, they've been having pretty muted reactions to earnings besides Tesla, but Meta, Google, Microsoft, all pretty muted. And then some of these older growth names like Roblox, Twilio, they're getting huge gaps on volume. So that's one thing to note. I think earnings season's a great time to really follow them, because what names are gapping up and what names are gapping down can kind of give you a hint into maybe what sector the institutions are rotating into. So that's the fintech sector, just textbook stage one bases. And then that's where, once they break out, that's when we get involved. Probably heard us say this so many times, but stocks make their biggest moves in stage two uptrends, and Upstart, AFRM, SOFI, TOST are all entering that stage two uptrend. So definitely keeping these on watch in the coming weeks and months.
All right, good stuff. I probably should have went to Ted first, because he's going to take a run through the stage analysis, and we'll start off with his first slide here. Ted, take it away.
Thanks, Don. So I've talked about stage analysis before, and Connor has as well, but I thought it was a good time to bring this chart back up, because we do see some diverging action in various sectors and in various names in this market right now. You have some strong names and some weak names. So here's a simple graphic outlining stage analysis. Essentially, there's 4 stages. Stage 1 is the basing phase, the accumulation phase. Stage 2 is the uptrend, and it's characterized by higher lows and higher highs. Stage 3 is the distribution phase. We'll start seeing some institutional sellers. You'll start seeing a break of the 50-day. You'll see the break of the 10-week. And you'll see more reversal candles, bearish engulfing candles, in that nature. And then finally, stage 4, you have the downtrend characterized by lower lows and lower highs. And the key moving average that we focus on for stage analysis is the 30-week moving average. However, you could also use the 40-week moving average just to have a little bit longer term time frame. So on to the next chart, Don. If you bring up the Bitcoin chart, I think it outlines or highlights this cycle extremely well. And actually, before I start, I just want to mention that there are no certainties in the markets, but if there were to be one certainty, that would be cycles. The market cycle, the economic cycle, the credit cycle, and we study cycles because we want to be able to understand what stage we are in a market cycle or in a price cycle, to kind of help us have a proper expectation of what should happen in the markets. So looking at Bitcoin on the very left side of this chart, this extends all the way back to 2020 and 2019. That gray area, as you can see, more or less is just a period of sideways action. Didn't really make any big price move. That's where weak hands are capitulating to strong hands, and strong hands are accumulating Bitcoin. Or this could also be a stock, so accumulating stock. And then when you see when we broke out into new 52-week highs, that green area is where the majority of the move took place. Now, at some point, you'll start seeing distribution, institutions, and big hands start selling, and that is the orange phase. And again, price starts heading sideways. It oscillates within a range. At the top of the range, that's where big hands and stronger hands sell, and then eventually the sellers overpower the buyers, and you head into that red box, a stage 4 downtrend. And now, at the end of that, you start the cycle all over again. So you see that gray area, accumulation phase. We recently had a stage 2 uptrend, that green box that I highlighted. And so now we're at a really critical junction. And that is why I use Bitcoin as an example. In yesterday's market pullback, we saw relative strength of Bitcoin just pulling back to its 8 EMA and starting to build out this right side and this handle. But the thing is, you can look at this chart and wonder to yourself, is this going to turn into an orange box and end up becoming a stage 3 top that leads to stage 4 downtrend? And we don't know at this very moment what it could, if it will turn out to be that case. But right now, it looks like it wants to choose upwards. And if we do take out 74,000, that will reconfirm into another green box. And on that note, I do want to talk about how you can skip stages as well. You can go from a stage 1 accumulation phase to a stage 2 uptrend, then to a potential stage 3 top. But if that chooses to the upside, that's just another stage 2. Or it can obviously head downwards, and that would enter stage 4 decline. And then in the stage 1 to stage 2 area, you can have a stage 1 basing phase or accumulation phase that appears to head in stage 2, but can refail back into stage 4. I don't have an example for that this time around, but that is some characteristics about stage analysis. And then why I wanted to bring this up, when we respect these stages, whether a stock's in the uptrend above the 30-week making higher highs or higher lows, or stock is below the 30-week making lower highs and lower lows, typically in the stage 4 decline phase, you'll start having bad news come out of the blue, and you'll have serious gap downs, surprise news events. And this is where, Don, if you can pull up SMCI, you had an enormous move out of a huge base that went up about 300%. And then distribution came into the market. If you can go to the weekly chart, it'll probably look even better. So we had that huge 300% move, and then distribution started plaguing this ticker. And actually yesterday we found out that, or actually was it yesterday? It was this week. It was either yesterday or the day before yesterday. We found out that their auditor, EY, decided to part ways with them. And that is arguably one of the worst things that can happen to a company. It just means that their financials are so screwed up that even the auditor wants to ditch them and wants nothing to do with that company anymore. And I highlighted the two moves. This downside move has hit about 78%. And Dan has mentioned on previous podcasts that the average leader drops 72% from its peak when it does top. And SMCI fit that bill perfectly so far. It's not to say that it's done dropping here. This could head all the way back and give up the entire move, especially if it's a fraud and they've been faking revenues or sales of their racks for data centers. And this just really, like, the point I want to make here is that you want to avoid stocks in stage 4 and you want to buy stocks in stage 2, and you'll avoid a lot of headaches and trouble. And finally, another thing I want to point out is that there's divergent action in the semiconductor sector. And back to my point of sticking to stage 2 and away from stage 4, not all charts are created equal. You have to judge them by their character. And the two stocks I want to show first is NVDA and TSM. Of course, if you go on the weekly chart, from what I've shared, you can easily tell that they're both in stage 2 uptrends so far. I won't describe the characteristics on these charts too much. You can just quickly show NVIDIA and TSM. Maybe leave it up there for a few seconds for the listeners to see. And then in the same sector, you also have stocks like ASML and KLAC that are complete stage 4 downtrends. And they're in the same sector, but the two charts in stage 2 are not created equal at all to the two charts in stage 4. And if you thought that you could just buy any semiconductors stock, you're thinking that you missed NVIDIA, so you're going to go bottom fish the lower stocks, the lower RS names. You're not really having a great time with that at this point. LAC and ASML.
It'd be a great pairs trade, Ted. If you're an active trader, you go long the good ones and short the bad ones, and then you kind of have a hedged, pairs trade.
Definitely, yeah, definitely. And yeah, so stage analysis covered that. Bitcoin was the example, and I put that in here because I thought it's quite pertinent. We'll see what happens, how that develops the right side of the space. We, of course, own it and grow. Full disclosure there through IBIT as well as MSTR. And yeah.
There's IBIT. All right, excellent presentation. And like you said, not all semiconductors are created equally. Timeless stage analysis by Stan Weinstein that Ted just went through, definitely something we use in-house here. We don't talk about it a lot, but really the foundations and the rules that he lays down translate very nicely to what William O'Neill and his principles are. Yeah, it's just a matter of canceling versus stage analysis.
Well, I think they.
All right, Dan.
You like them together, right? They work in
Well,
tandem.
yeah, they absolutely do. Yeah,
confirmation. All right, folks, listen. I did want to read the mailbag real quick. I wanted to dive in the markets first, so I kind of skipped over that because I'm going to do the de-dollarization very quickly. But here we got a mailbag 1024 from HS. Hi, Dan and Don. She's a new client, full disclosure. Hi, Dan and Don. Congratulations on the increase in AUM. As a new client since August, I can see why more people are becoming clients. The transparency on YouTube is priceless. One question, with the increase of AUM, is there any impact on the way portfolios are managed? Thanks, HS. Don, hi, HS. Thanks for the kind words. Great to hear from a happy client. Great question. We have evaluated that in-house and feel we won't be significantly impacted until we grow about double from where we are. We're currently about 200 million, so about 400 million. We have a plan to address it in ways current clients wouldn't be impacted. Take care and thanks again. On my side note, you may want to join Revere before this happens because those clients are going to get grandfathered into the original system. Anyway, we have had dozens of new signups in the newsletter since Don's free Wednesday, 5 p.m. IBD YouTube video, and like 4 clients in the last 4 days. So I put if you have not seen his IBD, this is free. This is not IBD Live. He did the IBD Live a couple times. That's an expensive paid thing for, very serious investors. Traders. This one is just IBD. There, Don's got it on the computer. Zach, can you show that real quick? And it's on YouTube, and you can just Google investing with IBD, and you can watch it. But it's in our show notes. And then on 1028 MB, the 2 articles, the Make America New Supercycle that I went over, I kind of butchered it. Sorry about that. And the De-Dolarization. These are going to be fundamental changes. I want to cover this just very quickly before we go. I didn't want to talk about the dollar and the currency and the devaluation too much while we're talking about stocks, but this is that China faces a long road to de-dollarization. Okay, the role of the dollar has been quite significant, but here's the thing. Everybody's talking about Russia and China taking down the dollar, and it's not going to be the world reserve currency. Well, there's a couple of different things, and nobody really knows how this is going to play out. Okay, but for the role of China or somebody to take us over, there's a couple things you got to realize. First of all, the role of the dollar is a store of value. People want the dollar. They feel good about it, number one. Number two, emerging markets and emerging market countries. Nobody wants Zimbabwe dollars. Nobody wants bonds in emerging market debt. That's why they have to do it. A lot of emerging market debt is done in American dollars, so it's needed. Now, Joe Biden just gave away the petrodollar about two months ago. That could have a significant impact on inflation down the road. Why he did that, I have no idea. But anyway, so now, before Arabs you always had to buy oil in U.S. dollars. Even so, if you're Russians, you had to get U.S. dollars to go buy the oil and then take it. You couldn't. You got to translate your Russian rubles into dollars. You don't have to do that anymore. Saudi Arabia is willing to sell it directly to China or Russia. So now you don't necessarily have to have the dollar, and that could decrease demand. Why is that important? 2/3 of all the U.S. dollars are abroad. So remember what I told you. If you have massive supply and your demand goes down, because now globally the demand is going down and they're borrowing more money, that's where you could have inflation. All right. But here is the thing. Everybody thinks this is so damn easy to just get rid of the U.S. dollar. There's technical difficulties. Number one, calculating the values and all these cross changes of currencies. Now, with AI, that's going to make it more easier to do. Okay. But to substitute, here's the problem. China wants to control their currency and they want to manage it and keep it really tight. You can't have currency controls. You can't have currency restrictions and limit liquidity and be the world's reserve currency. It doesn't happen. Okay. But also, if the Chinese yuan, and if they've got a stable currency, their yuan strengthens. Well, if their yuan strengthens, it hurts their exports. So how does China strengthen their currency and make it a legitimate currency that people aren't worried about big devaluations like an emerging market country like Zimbabwe, right? And not hurt your exports. See, that's the problem China's going to have to try to become the world's reserve currency. It's going to crush their exports. So that's going to be a problem. That's why it's not quite as easy. The mechanics of just switching to the US dollar, you're at least 5 years out and probably 10 to have a material effect. But regardless, you follow the charts, whether we're right or wrong. And I don't talk about this enough. At Revere, if you ever need physical precious metals, we can help with that. I'm tied in with one of the top 4 biggest global wholesalers. They're tied in with the Perth Mint, the Philharmonic Mint in Austria, the Canadian Mint. Hell, I can get it stored for you in Canada right next to the Royal Mint of Canada, and you can go look at your own gold within 24 hours if you want. Delaware, even Dallas. They're all over the place, and they can drop ship it directly to your house if you need that. But just be wary. It's good to have as an inflation hedge, maybe 5-10% of your portfolio against paper assets, okay? But that's all you need. You don't need to become a gold bug and buy 50 or 80% gold. It's too hard to travel. It's too hard to take around. There's other ways to do it. So the long-term insurance against paper assets, bond stocks, all that stuff would be an would be a hedge on gold. That's what you buy gold. Now, the other thing, to make sure you don't get screwed with your money, everybody's going to tell you buy an American Eagle because American Eagle's $25 more a coin than a Cougar. Last one I got was for a client was a Cougaran. Time before that, it was a kangaroo, Australian kangaroo. Why? Because it was the cheapest at the time. I just care about the 1 ounce of gold. And everybody says, well, but it's the American Eagle. You'll get it back when you pay for it. Folks, if you're buying the gold as the Armageddon scenario, as the insurance policy, look, if you're just buying gold as a stock, to increase in value, buy GLD or even an IUA. You don't need to buy physical gold. Physical gold is for the insurance against paper assets. But if it really hits the fan and the dollar is getting slaughtered, the eagle doesn't matter anymore. Nobody cares whether it's a kangaroo or an eagle on the face of that coin. They just want to know it's 1 ounce. That's why you buy a sovereign coin with a certain weight and a certain circumference so you don't have to drill a hole in it and assay it. Okay? I know a lot about precious metals. We don't talk about it on the show simply because we're more stock people, but I do help with that because I see people getting screwed all the time, both in bond and fixed income portfolios, in physical precious metals, and oh my God, in annuities. Okay? If somebody's trying to sell you an annuity, call me first. All right? Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com. Up in the top right-hand corner, there's a subscribe button. This podcast will go in your inbox every Saturday morning, and the team does a daily market insight video every night the market's open. We actually show you what we're actually doing. We're the most transparent advisor out there because it's your money. It's not their money. And you should know what the hell someone's doing with your money. If you don't know exactly what your advisor's doing, call them. We show you that night. All right? You can email. Next to it is a contact us button. You can shoot me an email, a stock you want talked about, a topic, or you can even tell me I'm wrong. Let's have a debate on your money. You can always call us, 855-REAL-WEALTH. We'll talk to you next week on your money.
And have some lead to protect your gold, because it's not how much you make in the markets, it's about how much you can keep.